Everyone tells you to just buy and hold Bitcoin. It's the gospel of crypto investing, preached from every corner of the internet. But what if that advice, the very strategy meant to keep you safe, is precisely why most investors are leaving life changing money on the table? You felt it. You watch your portfolio skyrocket during a bull run, numbers on a screen that could change your life, but you don't take profits because you're told to hodl. Then the inevitable happens. The market turns. You watch those same numbers bleed out day after day, frozen by the fear of selling at a loss. You tell yourself it'll come back, but the damage is done. Not just to your portfolio, but to your conviction. There is a better way. In this video, I'm going to show you a powerful portfolio model that a small group of sophisticated investors use. This isn't about perfectly timing the market or finding the next 100 times memecoin. It's a disciplined, rules-based system designed to do one thing: build and protect wealth through crypto's violent cycles. This is the strategy that can turn market chaos into your biggest advantage, and I'm going to show you exactly how to set it up step by step. First off, let's be clear, buy and hold isn't a bad strategy. It has created tremendous wealth, especially for early Bitcoin investors who had the iron will to never sell. For Bitcoin, it has historically been a winning formula. But for a diversified portfolio of crypto assets, it's a passive approach in a market that is anything but passive. The core problem with a pure buy and hold strategy in crypto is that it completely ignores the single most defining characteristic of this asset class: volatility. We're talking about an asset class where 50% drawdowns are common and 80 to 90% drawdowns on altcoins are a rite of passage. While Bitcoin's volatility has been stabilizing, now trading more like a major tech stock, the broader crypto market remains a wild ride. A simple buy and hold approach means you are strapped into a rocket without a parachute. You're just along for the ride, for better or worse. Here's how this trap snares the average investor. You build what you think is a balanced portfolio. Let's say you start with 50% in Bitcoin, 30% in Ethereum, and 20% scattered across a few promising altcoins. The bull market kicks in, and your altcoins, being more volatile, explode in value. That 20% allocation quickly balloons into 40%, then 50%, or even more of your total portfolio. Without even realizing it, your once balanced portfolio is now dangerously overexposed to the highest risk assets you own. You didn't actively decide to take on that much risk, the market decided for you. And when the music stops, and it always does, those same assets that gave you euphoric gains will lead the charge downwards, wiping out a huge portion of your paper wealth. Your risk exposure changed without your consent. This is the hidden risk of holding. You become a victim of your own success. Your winners run so hot that they completely unbalance your entire financial position, leaving you vulnerable when sentiment shifts. It's a recipe for emotional decision making, panic selling at the bottom, and ultimately portfolio destruction. The pros know this. They know that volatility isn't something to be feared. It's a tool to be used, and they use it through a system. So if buy and hold is a flawed map for navigating crypto, what's the alternative? The answer is a dynamic, two-part system adapted from what institutional investors have used in traditional markets for decades: dynamic rebalancing and volatility targeting. This might sound complex, but the logic is incredibly simple and powerful. Instead of passively letting the market dictate your portfolio's risk, you actively manage it. This system gives you a clear, unemotional, and automated set of rules for two of the hardest things in investing: when to take profits and when to buy the dip. Part one is dynamic rebalancing. At its core, rebalancing is just systematically selling assets that have grown too large in your portfolio and using the money to buy assets that have shrunk. Think of it as a disciplined profit taking machine. When your altcoin allocation skyrockets from 20% to 40%, this system forces you to sell that excess 20%, locking in those paper gains. You are automatically, systematically selling high. There's no emotion, no greed, no wondering, what if it goes higher? The system makes the decision for you based on the targets you set. Part two is volatility targeting. This is the other side of the coin, your buy the dip engine. The cash you harvested from rebalancing your winners doesn't just sit there. It becomes your dry powder, a strategic reserve waiting for an opportunity. Volatility targeting gives you a clear signal on when to deploy that capital. Instead of trying to catch a falling knife, you use volatility itself as your trigger. For example, you might set a rule to start buying a high conviction asset like Ethereum after it has dropped 30% from its recent high. High volatility, which causes panic in most investors, becomes your green light to acquire quality assets at a discount. Together, these two parts create a beautiful self-sustaining loop. Rebalancing generates profits and cash. Volatility targeting uses that cash to buy assets when they are on sale. Sell high, buy low. It's the oldest advice in investing, but this system turns it from a vague platitude into a concrete, actionable strategy. It transforms you from a passive passenger into an active navigator, using the market's own energy to fuel your portfolio's growth. And while its effectiveness can depend on market conditions, data shows that for pure crypto portfolios, systematic rebalancing can be a powerful way to capture profits from volatility. Before you can use this strategy, you need a strong foundation. This is the most crucial step as it defines the home base that your rebalancing strategy will always return to. This is where you decide on your ideal portfolio structure. Think of it like a blueprint for a house. Your target allocation is a reflection of your goals, risk tolerance, and conviction in different crypto sectors. There is no perfect allocation, but a great framework to use is the core satellite model. Remember, the following is just an example. You should adjust it to fit your own research and comfort level. Step 1. Define your core holdings, the bedrock. Your core should be the most established, liquid, and relatively safer assets in crypto. For most people, this means Bitcoin and Ethereum. They have proven resilience, have the largest network effects, and are the most likely to survive long term. Institutional grade portfolios often anchor themselves with 50 to 70% in these core assets. Let's use a practical example for a $10,000 portfolio. A solid core allocation might be Bitcoin, BTC, 40%, $4,000. Your digital gold, the market leader. Ethereum, ETH, 20%, $2,000. The dominant smart contract platform, the foundation of DeFi and Web3. This 60% core provides stability for your entire portfolio. Step 2. Select your satellite holdings, the growth engines. The satellite portion is where you take calculated risks to capture bigger returns. These are your high growth bets. But don't just pick random altcoins. Think in terms of sectors or themes. In 2025, key themes might include decentralized finance, DeFi, layer 2 scaling solutions, real world assets, RWAs, and AI/blockchain integration. For our $10,000 portfolio, a satellite allocation could look like this. DeFi blue chips, 10%, $1,000. One or two established leaders in decentralized finance. Layer 2 solutions, 10%, $1,000. Projects focused on scaling Ethereum. High-risk emerging narratives, 10%, $1,000. Your moonshot basket. This could be spread across 2 to 3 smaller projects you believe have massive potential. Step 3, establish your stability component, the dry powder. This is the part most people neglect, but it's critical for our strategy. You need a portion of your portfolio in stablecoins. This lowers your overall portfolio volatility and provides the dry powder you'll need to buy dips without having to sell other assets at the wrong time. For our example, stablecoins, e.g. USDC, USDT, 10%, $1,000. So our final example target allocation looks like this. Bitcoin, 40%, Ethereum, 20%, DeFi, 10%, layer 2s, 10% high-risk altcoins, 10% stablecoins, 10%. This is your blueprint. Write it down. Put it in a portfolio tracker. This is the state of balance you will continuously return to. Now that you have your target allocations, it's time to build the engine that runs your strategy. This is the system that enforces the sell high discipline. The concept is simple. Whenever your portfolio drifts too far from your targets, you trade to bring it back in line. The key is to define when and how. There are 2 main ways to trigger a rebalance. Method 1, periodic, time-based rebalancing. This is the simplest approach. You set a fixed schedule, say monthly or quarterly, and on that day, you rebalance your portfolio no matter what the market is doing. Let's walk through an example. Imagine it's been 1 month and altcoins have been rallying hard. Your $10,000 portfolio is now worth $14,000, but it looks like this. Bitcoin, $4,200, now 30% of total. Ethereum, $2,500, now approximately 18%. DeFi, $2,800, now 20%. Layer 2s, $2,800, now 20%. High-risk altcoins, $1,400, now 10%. Stablecoins, $300, you spent some. Your allocations are a mess. Your DeFi and Layer 2 buckets have doubled to 20% each, while your Bitcoin has shrunk to 30%. You're way more exposed to altcoin risk than you planned. On rebalancing day, you would. Calculate new targets. Your portfolio is $14,000. Your Bitcoin target is 40%, $5,600. Your DeFi target is 10%, $1,400. Sell the overweight assets. Your DeFi and L2 buckets are each $1,400 overweight. You would sell $1,400 from each. Buy the underweight assets. You're $1,400 short on Bitcoin and also low on stables. You'd use the $2,800 from your sales to bring everything back to its target percentage. You just took $2,800 in profits from your high flying altcoins and secured them. No guesswork involved. Method 2, threshold, deviation based rebalancing. This method is more dynamic. Instead of a fixed date, you rebalance only when an asset deviates from its target by a set amount, like 5% or 10%. This is more efficient as it avoids trading in quiet markets but acts fast during volatile periods. Using our portfolio, you might set a plus or minus 5% threshold. Your target for DeFi is 10%. The moment it hits 15% of your total portfolio, the trigger is pulled. You'd sell that excess 5% and reallocate the funds. This is much more responsive to sudden market pumps. Which method is better? For most people, a mix works best. A scheduled monthly or quarterly check-in is great for general maintenance. But for your high-risk positions, a threshold-based trigger is superior for capturing profits from explosive moves. Studies suggest threshold rebalancing is often superior for pure crypto portfolios. Many modern portfolio tools can automate this for you. Platforms with rebalancing bots let you set your targets and frequency, and the tool handles the trades automatically. This is the ultimate expression of the strategy. A completely automated, emotionless system for taking profits. Your allocations are a mess. Your DeFi and Layer 2 buckets have doubled to 20% each, while your Bitcoin has shrunk to 30%. You're way more exposed to altcoin risk than you planned. On rebalancing day, you would calculate new targets. Your portfolio is $14,000. Your Bitcoin target is 40%, $5,600. Your DeFi target is 10%, $1,400. Sell the overweight assets. Your DeFi and L2 buckets are each $1,400 overweight. You would sell $1,400 from each. Buy the underweight assets. You're $1,400 short on Bitcoin and also low on stables. You'd use the $2,800 from your sales to bring everything back to its target percentage. You just took $2,800 in profits from your high-flying altcoins and secured them. No guesswork involved. You've built your profit-taking engine. You are trimming your winners and building a war chest of capital. Now, it's time to build the second part of the system, the buying engine. This is how you deploy that capital intelligently. You need a system for buying the dip that is just as disciplined as your system for selling the rip. This is where volatility targeting comes in. High volatility scares most people, but for you, it's now a signal of opportunity. The goal is to use sharp price drops in high conviction assets as your entry signal. You aren't trying to time the absolute bottom. That's a fool's game. You are simply aiming to acquire assets at a significant discount. Here's how to build your volatility buying engine. Step 1. Identify your high conviction buy the dip assets. Don't apply this to every asset. This is reserved for projects you believe in for the long haul. For most, this will be Bitcoin and Ethereum. You might have one or two other blue chip altcoins on this list, but keep it short. These are the assets you feel are undervalued when the market panics. Step 2, define your volatility triggers. You need a concrete numerical trigger that tells you it's time to buy. This removes emotion from the decision. Here are a few simple triggers. Fixed percentage drawdown, the easiest method. You set a rule to start buying an asset after it has fallen a specific percentage from its recent high, e.g., a 60-day high. For example, Bitcoin. Start buying after a 20% drop from the 60-day high. Ethereum. Start buying after a 30% drop from the 60-day high. High conviction altcoin. Start buying after a 40 to 50% drop. Technical indicators, advanced. For more advanced users, you can use indicators like the average true range, ATR, to measure volatility. But honestly, a simple percentage drawdown works just fine. Step 3, create your buying tiers, scaling in. Never deploy all your dry powder at once. The dip can always dip further. Instead, you scale in with multiple buy orders. Let's say you have $2,000 in stablecoins from your profits, and your target is Ethereum. Your buying plan could be trigger 30% drop from the 60-day high. Buy one. Once the trigger hits, deploy 25% of your dry powder, $500. Buy two. If the price drops another 10%, a 40% total drop, deploy another 35%, $700. Buy three. If the price drops yet another 10%, a 50% total drop, deploy the final 40%, $800. With this system, a market panic is no longer scary. It's an exciting event. You have a plan, you have the capital. A 40% drop in Ethereum isn't a disaster. It's your pre planned opportunity to acquire a world class asset at a massive discount funded by your earlier profits. This completes the loop. Rebalancing forces you to sell high, volatility targeting gives you a clear plan to buy low. You can even automate this by setting limit orders on an exchange in advance. Set them and forget them. Let the market's panic fill your bags for you. Let's run through a simplified example to see the difference this strategy can make over a market cycle. It's important to remember this is just an illustration. Real world results will vary. We have two investors, both starting with $10,000, split 50% BTC and 50% ETH. Investor A is the HODLer. They buy and hold no matter what. Investor B is the Rebalancer. They rebalance back to 50-50 whenever one asset becomes 60% of the total. Phase 1, the bull run. The bull market kicks off, and Ethereum, being more volatile, outperforms Bitcoin. After 6 months, Bitcoin has 2x'd, but Ethereum has 4x'd. HODLer portfolio: Bitcoin $5,000 to $10,000, Ethereum $5,000 to $20,000, total value $30,000. The HODLer feels like a genius. Their portfolio is now 67% ETH. Rebalancer portfolio: as Ethereum outpaced Bitcoin, the Rebalancer was continuously trimming ETH profits and buying more BTC to maintain the 50-50 split. By the end of the 6 months, let's say their portfolio looks something like this. They have more BTC but less ETH than the HODLer. Bitcoin worth $12,000, Ethereum worth $12,000, total value $24,000. At the peak, the HODLer's portfolio is worth more on paper. This is a crucial point. They feel richer, but their wealth is fragile and concentrated in the riskier asset. The Rebalancer has less paper wealth, but has accumulated more of the core asset, Bitcoin, and has a more stable position. Phase 2, the bear market. Now, the market turns. Typically, the more volatile asset falls harder. Let's say BTC drops 50% from its peak and ETH drops 75%. HODLer portfolio: Bitcoin $10,000 to $5,000, a 50% drop. Ethereum $20,000 to $5,000, a 75% drop. Final value $10,000. The HODLer is right back where they started. All their paper gains are gone. They're emotionally crushed. Rebalancer portfolio: Bitcoin $12,000 to $6,000, a 50% drop. Ethereum $12,000 to $3,000, a 75% drop. Final value $9,000. But wait, the Rebalancer has less money now, right? Yes, but here's the magic. At the bottom, their rebalancing system tells them to sell some of their now overweight Bitcoin and buy the heavily discounted underweight Ethereum to get back to a 50-50 split. The aftermath: preparing for the next cycle. Let's compare where they stand. The HODLer has their original number of coins, a $10,000 portfolio, and is probably emotionally scarred. The Rebalancer has more Bitcoin and more Ethereum than they started with, a portfolio worth $9,000, and a clear, unemotional plan. They systematically sold high and are now systematically buying low. When the next bull run starts, the Rebalancer is in a vastly superior position. Their larger stack of assets, acquired at depressed prices, will lead to exponential outperformance over the HODLer in the next cycle. This is how sustainable wealth is built. It's not about having the highest portfolio value at the peak of a bubble. It's about systematically increasing your asset base over time. This strategy sacrifices some euphoric highs to help cut off the devastating lows. What we've just walked through is more than a trading strategy. It's a fundamental shift in how you approach the market. It's about moving from an emotional reactive state to a logical proactive one. Buy and hold leaves you at the mercy of the market's wildest mood swings. It forces you to rely on hope and superhuman discipline, which almost always fail. This dynamic system does the opposite. It provides a rigid, rules-based framework that automates the hardest decisions. It automates profit taking, forcing you to sell high when greed tells you to hold on. It automates dip buying, giving you a clear plan to deploy capital when fear tells you to run. This strategy turns volatility from your greatest enemy into your greatest ally. Every wild price swing is an opportunity for the system to do its job. It removes you with all your human biases from the driver's seat and replaces you with a cold, calculating, wealth compounding machine. You no longer have to guess. You just have to follow your system. Managing a portfolio this way gives you control in a market that feels uncontrollable. It gives you a plan, and a plan is the ultimate antidote to fear and greed. This is how you stop being a gambler and start being an investor. This is how you survive and thrive through crypto's chaotic cycles. If you got value from this breakdown, do me a huge favor and hit that like button. It tells the algorithm this is the kind of in-depth content that serious investors want to see. And if you want to see exactly how I use automated tools to implement this entire strategy, check out the next video on the screen. Make sure you subscribe and hit the notification bell so you don't miss future videos where we explore more advanced strategies to give you an edge in the crypto market.